Welcome to Right on the Money, the weekly talk show with interviews you can use to help you maximize your money and optimize your financial future. Before moving forward with any of the ideas discussed on the show, always consult your financial advisor, insurance professional, or tax consultant. Looking for financial help or a second opinion? We can help you in your search. And now, your host of Right on the Money, syndicated financial columnist and money-colored commentator, Steve Savant.
Well, welcome everyone to our conservative investor and savers edition of Right on the Money. And here to bring us up to speed that with all that is conservatism, our investment financial advisor, Eric Judy. Hey, Eric.
Hey, Steve. How are you doing today?
I'm well. Welcome to the show.
Thank you.
I want to point out Eric's new book, New Retirement, a Paradigm Shift. He co-wrote this with his partner, Dick. What's Dick's last name?
Dick Van Dyke.
Dick Van Dyke.
Not the actor.
Okay, not the Dick Van Dyke. And this is a really great book. It's also out on the e-version, I think. You have it?
Exactly right.
And they have a regular weekly blog every week talking about really cool things, and some of that is annuities. And we're talking about conservative investments. I mean, when I'm looking at today, the guarantee, I'm looking for guarantees. People are going to the bank. Not much there. I was on bankrate.com, Eric, and the one-year rates were like a point maybe.
Well, right now, savers, retirees, people that are trying to save money, I hate to say, there's an attack on them right now in the economic community. There's just not lots of opportunities for people to go out there and to be able to supplement their retirement income from the traditional CDs, savings accounts. Unfortunately, you just can't go there and expect to earn enough to have enough to really retire on.
Well, Eric, I mean, the Fed raised their interest rate a quarter of a point. Now, I maybe we'll see something on the borrowing side of that equation, but I haven't seen anything on the savings account.
I don't know if this is trickle-up economics is what we're looking at, but yeah, it still hasn't impacted significantly what's out there savings side.
Well, I'm looking for things that are guaranteed, and let's just stay on the fixed rate just for a second before we get into what we want to talk about. I'm looking at 5-year rates on CDs. They're probably sitting around 2.25 or so right now. Remember, don't always check before you go out there. I'm just telling you what it is today. You need to go to bankrate.com, get a good feel of what's going on. The non-brick and mortar seem to be having the banks seem to have a bigger.
Exactly. Yeah, the online world seems to be offering better rates.
It is. So you might look at that. But I've noticed that the annuity, we're still sitting around 3 for a 5. So we're about, 50, 75 basis points up over the national average.
Exactly. If you're looking at some of the smaller deposits, you're probably 2.75 in today's world. But really, if you're $200,000 or above, there's rates out there of 3% and higher.
Okay, did I just hear you that there's a little different definition of jumbo, and CDs are usually looking for 100,000. Maybe in our language for annuities, you're saying maybe 200,000.
Exactly, and it does differ by carrier.
Okay,
but usually there are some carriers that have tiered rates. So if you have those higher dollar amounts, you do have at times an opportunity to get a little bit of a bump there.
Well, a lot of retirees, a lot of seniors are looking there. I mean, especially we this first part of this month was brutal. Dow lost 1,000 points. Right. Everybody's running for shelter, but the banks aren't paying that much. The savings accounts aren't paying that much. My money market attached to my brokerage accounts look terrible.
Well, unfortunately, it costs more to mail you the statement usually than what you're earning in interest.
Well, I have to say, I noticed that one of my mutual funds and ETFs, I noticed that the actual cost of the fund was greater than what they were paying me. I'm losing on the cash issue alone. Wow. Well, let's talk about guaranteed. We just talked about some guaranteed lockdown monies, trying at least for savers. A lot of people are now looking, okay, Steve, I'm kind of at that part where I'm ready to become a true retiree. So the boomers, about half of us now are already retiring. The other half, we're still thinking about retiring. Some of us are in between looking at a hybrid retirement. We might work through to 70 and maybe even work and bring our retirement income as long as we can do that. Talk to me about the whole guaranteed idea of guaranteed income. And let's do the first one, which is guaranteed income I cannot live.
Sure. And that's what most people are looking for. I mean, everybody likes the idea of having a pension. Everybody likes the idea of having a Social Security check. Easy for me to say. But they want those guaranteed. They want something they can't outlive. And so when you're looking at an annuity, a lot of times people are looking for guaranteed income. They want that lifetime. Mm-hmm. They don't want to have something that, they get up into their 90s and all of a sudden it goes away. Mm-hmm. And as you look at the annuity options, you've got income riders, which are kind of I'll call them the new kids on the block. Mm-hmm. They've been around for probably well over 30 years now. And you're looking at, annuitization. And when people are balancing out, they're having to look at those two considerations.
Well, let's walk through that just because we're a consumer show.
Right.
Let's talk about the easy one first. Let's do annuitization. What does that mean? What is it? What is it? What's the pros and cons?
Sure, and this really dates back to, I think, the Roman era when you're talking about annuities. And it's really what you're doing is you're taking your savings, your lump sum, and you're giving it to the insurance company in exchange for a stream of payments. Now, you get to dictate kind of what that stream of payments is. It can be lifetime. It can be 5 years, 10 years, 7, whatever that number needs to be, you can set that. You can also set lifetime with minimum guarantees. But what you're looking at there is giving up control. You're really giving the insurance company that lump sum in exchange for that guaranteed stream. And that's really what annuitization is.
Well, I think there's some people that I'm kind of maybe on some of mine, not all of it, but some of my money, I might want to give up control because I like the idea of having guaranteed income I can't outlive. So if I turn out to be the Guinness Book of World Records Gene Calment, who lived 122 years, 164 days, I know they're going to make the payment. So I don't know if I want to do that with all my, but I'd like to build a floor of retirement with that. Now, that's annuitization. And once I'm done, it's that I can't take that back. If you have buyer's remorse, that's an issue, right?
That's exactly right. Now, technically, I guess you could sell it on the secondary market, but you're going to get pennies on the dollar. So not recommended that anybody go into an annuity planning on annuitizing, planning on trying to liquidate. Now, there are some carriers out there that have the ability to have some sort of commutation to let you get out of these contracts, and that's relatively new in the industry. There's not a whole lot of those carriers out there. So if there is some kind of emergency or something you're thinking that's a safety valve you'd like to have, that's something that's a carrier-specific thing that you're going to want to investigate more as you're really seriously looking at that.
And I just have to recommend, really, you should have other liquid assets, really. There should be something in your reserve account before we start looking at unbundling or unwinding an annuity that we've annuitized.
And that's exactly it. You need to have liquidity out there because life gets in the way.
Well, what about the difference? That's annuitization. Everybody kind of said, I give a lump sum,
right.
I'm making the payments, it's going forever, it's guaranteed. I'm pretty in love with that.
And the nice thing about that is, and I'll tell you with annuities, that's typically going to be your best payment option. If you're looking for your highest payment, typically it's going to come from annuitization, especially when you're comparing it to the other options that we're probably going to consider here, and that's the income rider.
We'll talk about that because now, I thought, wouldn't it be the same actual payments? But no.
Well, with an income rider, all right, here's the deal. The reason you would elect to have an income rider tied to an annuity is to get that lifetime income guarantee. You don't get some of the other sub-guarantees, the 10-year certain, and those pieces typically associated with that. But with that income rider, you're going to guarantee lifetime income. But here's the catch. You get to still maintain what I like to term majority control. People will say, well, why majority control? Well, most annuities have a surrender schedule, surrender period. Let's just assume first few years it's a 10% surrender. You still have control over 90% of your dollars, even day one, on that type of annuity. So you're using the income rider to get the lifetime income guarantees, but yet you still have the ability, if you had to go in there, get those dollars and take them out, you could. So that's what I term kind of majority control on the income rider, but still having the ability to get life.
Which is a little different from the annuitization because that's when we're giving up control.
Right.
Okay, so when I'm doing income riders and I have a little bit more control now, if that's your psychological profile, I'm looking at income riders, and they have two issues that I want to cover off right up front, since we're going to be the whole day talking about a lot of these guaranteed issues, which is really it seems like the appetite right now for most conservative investors and savers. They're just looking for someplace to go.
Well, they're looking for someplace to go, and they don't want to. Annuitization, unfortunately, for some people, that loss of control just they can't stand it. And so this is why it's become a very popular option to say, give me the guarantees, but yet still leave me the control.
Okay, well, in income riders now, do I have to actually pay a price to attach a rider?
On the vast majority of carriers, yes, you're going to pay some sort of fee. Typically, we're seeing on most of the fixed products out there ranges of at least 50 basis points or a half a percentage point, all the way up to a point and a half.
Point and a half. Wow, that seems a little stiff. But there are some that are actually embedded in their contracts for free, right?
Yes, there are free options out there.
Okay.
So if you're looking for a free option, usually smaller benefits or some sort of stacked benefit comes in association with a free option.
This has to be shopped.
Oh, yeah.
And this isn't for self, this isn't one of those do-it-yourself issues either. Wow. Well, remember, if you're listening to our show on radio, iTunes, or a podcast, You can view the video version online at rightonthemoneyshow.com and request information on this segment. In our second segment, we're going to be talking about the hybrid annuity with Eric Judy. We'll be right back. Right on. The number one fear of American seniors is outliving their money in retirement. Hello, everyone. I'm Steve Savant, syndicated financial columnist and talk show host. The Guinness Book of World Records for living the longest is held by Gene Calment, who lived 122 years, 164 days. And that's a fact. But it seems like science fiction to consider living to age 150. But according to a leading gerontologist, that person has already been born. Every day in America, seniors are turning age 100. It's the fastest growing segment among retirees today. And tomorrow, you may very well be one of them. Could your retirement plan go beyond age 90, age 95, or even age 100? Now you can purchase guaranteed lifetime income no matter how long you live. And that income can also include annual increases to help maintain the purchasing power of your retirement dollar. So just go to www.rightonthemoneyshow.com and click on the free income calculator to determine how much guaranteed lifetime income you can purchase. Well, welcome back to Right on the Money and to our Conservative Investors and Savers edition of the said show, Right on the Money. Yes. Hello, everyone. I'm Steve Savant, syndicated financial columnist and money color commentator. In this segment, we're talking about the hybrid annuity with investment advisor Eric Judy. When I think about a hybrid, I mentioned the word hybrid. I was talking about, hey, you're going to have to work some and you're going to have to, in your retirement, maybe a hybrid to just make sure that things are going to be good for you. Maybe work till 70. Some of the boomers are already thinking that way. I am. But let's just talk about a hybrid annuity. When you use that phrase, Eric, it's in your book. What are you talking about?
Well, we like to think of a hybrid annuity as really kind of blending the best of multiple types of annuities. Looking at a fixed annuity, a fixed index annuity, and kind of an immediate annuity. Trying to take the blend of all those different styles and wrap them into one. And it becomes really a fixed indexed annuity with an income rider guarantee, which offers then lifetime income guarantee possibilities, but still has the potential for growth, either due to a fixed interest rate.
Okay, so when you're using an index for this hybrid, like the S&P 500.
Right, exactly.
Okay, as an example. So I have this annuity. I'm using the S&P 500 as our example. That could be any index. I mean, we do domestic, we do foreign indices now. I mean, this has really become big. So I have an index, and I can save with that, and then I can take out money anytime I want, whatever I want to do with it, or I could opt either, like we talked on the last time, I could either annuitize it, or if I want a little more control, I might want to use its income rider. Did I get that right?
You got it, okay. Exactly. So it's adding an element of guarantee to. But a lot of people still like that idea of having control, being able to get some continued growth. And a lot of these income riders come with some sort of guaranteed ratchet, guaranteed. As long as you hold it in deferral, they're going to have an increasing pool of dollars available for a guaranteed income later on. So
now that's the different than that is only for if you trigger the income scenario, not the accumulation of the true cash scenario.
Exactly, and I do think that's one of the biggest misconceptions out there in the industry. Too often I think I see people, let's just say, selling the sizzle of an annuity, and the sizzle is if I can say, hey, I can give you 7-8% guaranteed on the future income. Well, but people don't think on future income means it's not their money, not the real cash. It's really a ledger account. It's really, I like to call it the funny money bucket. It's really there to set that future income level for you when you're ready to start taking lifetime income. So that's really what that is. So when you're looking to defer something 5, 6, 7, 8, 10, 20 years even, those are some of the values people have because they still have control of the dollars, but still have a guarantee should they need it for lifetime income. Now, they're going to pay a fee for that, but a lot of people have that comfort level with having that guarantee.
I just want to make sure we're square on a couple issues here. One of them would be, I have a payout rate, like this gentleman you were saying, selling the sizzle of the 7%.
Right.
But my actual rate of return, money on investment, may be something different.
Exactly.
It has a lot to do with how long you're going to live.
Exactly. And it's in your cash account. You still have, you have to think of it as two separate accounts. You have the funny money bucket over here, and you have your cash that sits over here. Now, when you start taking income and you start taking those pieces, everything comes out of the cash side. But that ledger account establishes that base for what you'll be able to take for a future lifetime income or joint lifetime.
And I don't have to actually, when I when I go ahead and I actually apply for this, I don't have to actually talk about my income that day. I could worry about this later on and then trigger if I want to or not.
Exactly, and that's one of the beauties of it. If you remember old Saturday morning infomercials, I like to think of it as the Ronco retirement plan, where you can set it and forget it, in the sense of you put the dollars in today, you know what those guarantees are going to be 5, 10, 10 years, 5, 10, 20 years later, so you know what that income guarantee is going to provide for you when you get to that stage of retirement.
What is the client profile? I mean, people are listening to our show today. They say, hey, is that for me? What kind of person am I looking for that this fits from a suitability point of view?
Right, and from a standpoint of looking at who's going to want to purchase this, it's somebody who typically has guaranteed income sources, probably usually a Social Security. They may not have a pension. They may have saved from their 401k. They need something else to provide that foundational income for them. We're big fans of saying, there's certain things you want to have provided for you guaranteed. You're wanting to have food, shelter, those core pieces, and typically you want those things guaranteed with some sort of consistent, steady income. You may have saved millions of dollars. For those folks that haven't, they have a 401k, and they want to establish that income style for their future retirement. Having that type of annuity can be something that still gives them the flexibility of having control. So if things change, they think they're in a low interest rate environment now and they think things may change. It gives them the flexibility of still having control of the dollars, but still having that guarantee there that's in place for the future.
Okay, so if I'm looking at a profile, and a lot of seniors have that profile, by the way, and it's suitable for many seniors. I'm trying to match up my domestic spending that I'm going to have. Everybody's going to have bills to pay. That's not going away. Right. And they may go up with either inflation, even if we're in a deflationary. I don't even know the CPI sometimes actually tracks the true inflation. So I don't want to get into that on the show, but just that I might have a little bit of an increase every year. This is the first year in 2016 that Social Security did not get an increase. I kind of felt bad about that. And a lot of people at the lower end of the spectrum in the low middle class and more poverty areas of Social Security, that could be really hurtful. So let's talk about when I have the match. I've matched up to my suitability. I know I want the guaranteed income. I know I have the flexibility now. You said I could cash out. I don't have to trigger the income right away. I like that flexibility. When I'm looking at the rate of return, I'm giving up something. I'm not in the market now. I'm in the market with an index, but I'm actually getting credited the interest earnings on it. So there's some safety valves here. So if the market goes south, and remember, 215 was not good. About 70% of all people that were in the market lost money. So I like the idea of having a floor where I cannot lose the actual money in the account.
Right.
There are bills to pay in the policy, right? There's expenses like any financial product.
Exactly.
But at least that's zero. So if I feel like I'm a conservative, I listen to that. And if you say, Steve, I don't know if I am or not. If you want to order right from me, Steve at rightonthemoneyshow.com, I'll send you a risk tolerance test. Take the test, and it'll give you a general idea of where you fall out and if this is suitable. So your hybrid style, when I have other investments, so do you.
Right. So
we have things that are for growth, and we're in the market. We're doing ETFs, some mutual funds. Maybe you're doing REITs, maybe oil, gas, because you got tax issues. Whatever reason we're buying it, we're buying annuities really for the end game of ultimately some kind of an income.
Typically, it's going to be income. Vast majority of people want to have some sort of income. Now, we do have clients out there that will say, you know what, I just want something that I'm going to shelter from market loss. Still want some growth potential, so they can elect to have a fixed return or an index type return. But typically, if you're just looking for growth, you're not going to be adding that income rider. And that's always, you don't get caught with the sizzle there. You don't pay for the 5, 6, 7% ratchet roll-up piece because you're not going to take advantage of it. You're just looking for.
So I need to know why I'm doing this, right? So if I'm deferring this for growth, I'm not putting an income rider on. I'm probably not thinking about a new position, maybe in the future, but I'm not doing it now.
Right.
Okay. And when I'm looking at the issue of matching up a guaranteed annuity for my guaranteed domestic expenses, which are not going away, and maybe vacations to see the kids, I like that putting on this COLA rider. I noticed that some of these contracts will allow you to put on an inflation rider. I saw as low as 2%. I saw as high as 6%, which sounds like that's a lot of money.
Yeah.
They have a step up in your annuity payment from the day you retire, or you trigger the annuity, to all the way out to whenever you die. How big is that to put on inflation, and do you recommend it as a financial advisor?
Well, I recommend always having some sort of inflation-adjusted income. whether you do it through a COLA piece or you ladder out products that will come on at different stages, have some sort of segmenting, where you may have something for the first 5 years and then another piece comes on after that term. So
you can have little segments. They maybe 70. They start at 70. Another batch of money, another pot of money in the year starts at 75 or 80 or 85. I mean, so there's ways to stagger this income.
Yeah.
Okay, I like that.
Yeah. So you've got the COLA options. You have these riders that will automatically increase each year, but there's also a way of laying dollars out there to get, again, that Ronco retirement plan where you set it and forget it, have different pieces coming on at different stages.
Okay, now you've met a lot of people. You sell a lot of financial products. Some of the traditional issues that we already mentioned, mutual funds, ETFs, and so forth. You also sell annuities because a lot of people are moving. It seems like we're gravitating more to guarantees.
Yeah.
People should look at these ideas as a floor, a bottom line, so that they're never worried about what they're going to have to match up to their bills all the way out to the day that they die. Remember, if you're listening to our show on radio, iTunes, or podcast, you can view the video version online at rightonthemoneyshow.com and request information from this segment. In our third segment, we're talking about the impact of Social Security in retirement with Eric Judy. We'll be right back. Right now. The Guinness Book of World Records for living the longest is held by Gene Kalman, who lived 122 years, 164 days. Hello, everyone. I'm Steve Savant, syndicated financial columnist and talk show host. Will you live to be a super centenarian like Gene? Of course, no one knows how long they're going to live or if their family history will be any indication of their lifespan, especially in light of constant medical advancements. But the odds are ever increasing that a significant segment of seniors may live to age 100. But without some idea of your life expectancy, it's difficult to make plans for the future, especially for retirement. While there's no exact science in computing how long you live, you can get an idea by taking a life expectancy test. Then you can use the results to create a timeline for your own retirement plan. And don't forget, when you take the life expectancy test, always answer the questions honestly. So go to www.rightonthemoneyshow.com and click on the free life expectancy calculator and get an idea if you're really ready for retirement. Well, welcome back to Right on the Money and our Conservative Investors and Savers Edition. Hello, everyone. I'm Steve Savant, syndicated financial columnist and money color commentator. In this segment, we're talking about the impact of Social Security and retirement with investment advisor Eric Judy. Eric, Social Security, they changed the file and suspend. That's pretty much gone for everybody. Not all, but mostly all of us. The restrictive endorsement, unless you were 62 at the end of 2015, pretty much can't do that either. Right. So, they told us they weren't going to touch this stuff, but I guess they did. I remember back in the day, early on, just before Reagan came in, then they changed some more things. They're never going to tax Social Security. Well, they've changed all the rules, and I have to tell you have to kind of watch because Social Security interacts with your retirement. Talk to me a little bit about this because really this is really critical for us to make sure that we're maximizing and optimizing our retirement, and part of that is Social Security.
Yeah, and obviously the one thing we should factor in is to let everybody know Social Security is a legislative contract. Mm-hmm. It's not a legal contract. So necessarily whatever the rules are today, yes, they're subject to legislative change. We all have to do when we do planning, we have to use the rules as they apply today. And that's the most important factor kind of going in. So taking advantage and maximizing what's available for our retirees is really key because in all honesty, Social Security is truly one of the most efficient and optimized annuity platforms out there right now for retirees.
So I have to say, I try, and I've written a couple of articles on this all this month in January talking about baby boomers holding off till age 70 years. Anyway, I know sometimes you just can't. You just need the money. I agree with that. But if there's any way to get other resources or work a little longer, I say it's totally worth it. I mean, I'm not going to get 8% simple anywhere.
Exactly.
Right. And even if you did the compounding rate, I think it's probably around 5. But still, where are you going to get that guaranteed? So, yes, the government has there's no contract with America on this, by the way. I hate to say this. And there's IOUs in the bottom of the Treasury, the United States Treasury. IOUs because they've been picking at that. They've been borrowing from us since probably the Reagan era with Tip O'Neill. So what I want to do is I'm trying to figure out, okay, 62, I could take it, but I'm losing 25% discount on my Social Security immediately. Most boomers are at the full retirement age of age 66. And the age 70, which I hope we could creep to, if you can hold off, and those are your three
benchmarks, yes.
Yeah. So I think people don't understand how other investments, they think they know wages affect Social Security. You're working and you're taking Social Security, but I don't think they understand that their qualified plan is going to fall on the provisional income test to find out if their Social Security gets taxed or not.
And that's what's so key. I mean, and we talk about those qualified dollars, those required minimum distributions. A lot of people don't think of how they're going to impact their whole taxation aspect, including Social Security, until they get to age 70. And if they don't think about it prior to that, they've missed an opportunity. Many people may not be aware of what we call in the industry kind of the tax torpedo, but that aspect of not taking your qualified dollars until age 70, and then at that point in time, because you're forced to take so much out, you're then going to pay taxes on Social Security, and so, but you're missed kind of an opportunity probably. Many people, and there's a psychological aspect of Social Security, why people take it earlier. Many related to what we talked about just a few minutes ago. They're afraid it's going to change, it's not going to be there. All those aspects, their friends are taking it. Those things make people file earlier, but then by the time they get to the point where they're 70, if they've already taken those dollars, they don't really have a chance to go back and undo like they used to. And that's another change that's been made. Now you have a 1 year kind of look back where if you file, you can go back for that in that first year and kind of hit the undo button and let those roll-ups continue. But a lot of people are not thinking through the tax savings or the tax element of what they're going to have happen to them once they turn 70, and they have to start taking those required minimum distributions.
Well, I was just thinking of talking to a client the other day where he said, Steve, I did pretty good last year. I said, well, you're one of the few because 2015 was a tough year for many investors. And he was celebrating his capital gains. It was quite substantial. And I told him, I said, yes, you're only paying 15% on your capital gain, but the entire amount of your gain is flowing over to the provisional income test, and you're paying an ordinary income tax on your Social Security benefits triggered by a capital gain. And he was like, what? Wait a minute now. I thought I did this to reduce my tax. And another one, I noticed a client, so remember, a lot of us don't want to pay taxes, so we buy municipal offerings, and I'm all over that. I think it's a great idea. But remember, all the municipal income flows over to Social Security too,
right,
and that's counted as well. So when we're talking about taking our qualified plan out and our Social Security on top of it, we have to figure out, is there a strategy? And that leads me to my question on Social Security, Eric. There's a tax strategy here. We got to be looking at things that are like qualified monies, non-qualified monies, and maybe even tax-free ideas to try to reduce our complete tax bill when we're taking out our retirement and Social Security.
Exactly. Nobody likes to think of spending down their money earlier, but it's really a really pretty good strategy for a lot of folks that have a lot of qualified dollars, that they might want to spend those down from between, you retire at, say, let's just use the example of 62. You retire at 62. Well, do you really want to wait till 66 or 70 to start taking that Social Security? Well, if you think about the potential gains there, almost 150% more money if you wait that time from 62 to 70. Well, what if you use your qualified dollars during that time? So you're going to pay tax on just that portion, but Social Security is not going to be taxed because you're not taking it yet. It's going to be guaranteed that roll-up provision. So what you have then, by the time you get to 70, you maximized your guaranteed lifetime income at 70 from Social Security. The COLA factor, which is just astronomically enhanced because of the fact that you've given that, and you have the compounding effect by waiting till 70. So those pieces are significant in one of the strategies as far as doing that. And then also that we've got this kind of banding aspect of taking withdrawals all the way up to what your tax bracket is. Well, if you could have some room left there at the top of your band that you could take a withdrawal, you might want to look at taking some of those qualified dollars and converting them to Roth dollars.
Okay, now let's make sure we understand, because we're in a marginal progressive tax bracket. And as we move up into different brackets, but depending upon our income, and of course, remember, you're getting to offset that with deductions, tax credits, exemptions. But as I'm moving up, there's sometimes, he's alluded to, Eric's, this space. Right. You have a little bit more headroom before you go to the next bracket. Right. So since you're already paying that rate anyways, you might as well see if you can do a Roth conversion or spend down some of your qualified plans. So those are tactics, and you do this with your people. Is that correct? That's
what we're trying to do. We're trying to make retirement the most efficient, because ultimately it's all about bringing dollars back to you. And the most efficient and most tax-efficient way is about net income, not about gross income.
Now, when people file, I'm thinking about the impact. You were looking at Social Security's benchmarks. I mean, survivors could even get early as age 60. I mean, you could do that. So you're looking at survivors for 60, 62 is the benchmark. Full retirement for most boomers now is 66, and now we're looking at age 70. I think you're going to see. You heard it here first. I think they may have to start moving these timelines down future because of the longevity issue.
Yeah, I expect that to happen.
Now, I just want to add one other thing before we get out of here. Some of the mitigation, I can mitigate some of my RMDs by this new QLAC, Qualified Longevity Annuity Contract, which allows me to bump, not all, but some of my RMDs into the future.
Yeah, and I think that's a huge strategy for longevity. So your qualified longevity annuity contract, take a portion of your qualified dollars, kick them out there in case you do live to age 95 or 100. You know, toss them out there to age 85. I'm not saying throwing them all the way out there, but toss them out to age 85, and the leverage that you can get in dollars in return on investment is huge if in case you do have that long. And that's really what you are. You're hedging against that life expectancy, and you're able to do it and be much more tax efficient because you're taking qualified dollars that you don't have to then pull out at age 70. You're able to defer those.
Okay, so if I remember the rules of engagement here, we're talking about 25% of your qualified plan not to exceed $125,000 overall. And that can be for a married couple $250,000, right? I mean, total that you can defer past 70. So if you're looking to reduce your RMDs at age 70 using a qualified longevity annuity contract, I can't believe the government actually came up with this. And inside that, they use what is now known, we know now the last 2 years, but before that, nobody ever heard of this thing called a deferred income annuity. So they're using a deferred income annuity in a qualified longevity annuity contract that can push your RMDs out of the future. So managing Social Security, managing your RMDs in concert, you could lower your tax bill.
Oh, yeah.
And keep more of your money.
Exactly. And it goes back to kind of what we talked about earlier when we talked about laddering. Ladder QLAC as well. You know, there's no reason you can't set multiple pieces out there for a period of time.
Okay, so if I said I don't want to put it in one contract, I could start some of my QLAC at 70, 75, and age 80. Wow. But remember, if you're listening to our show on radio, iTunes, or a podcast, you can view the video version right on rightonthemoneyshow.com and request information from this segment. In our fourth segment, we'll be talking about fixed annuity rider myths with Eric Judy. We'll be right back. Over 50% of those who have life insurance may be in the wrong rate class and more than likely are paying too much for their coverage. Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. Sometimes you just need a second opinion to determine if you're actually getting the best deal. The insurance industry has just updated the mortality tables to reflect longer life expectancy, so premiums are expected to go down. And additionally, there are life insurance companies that are more benevolent if you have a medical problem than other companies. And when you consider that most life insurance companies offer lifestyle credits for those who practice good living habits, well, you could save a lot. But an additional value here is the vast majority of life insurance companies offer a free blood and urine analysis, a test that costs hundreds of dollars and with no obligation to buy. With hundreds of life insurance companies competing for your business, you could pay substantially less. So if you have a life insurance policy and you want a second opinion, just go to www.rightonthemoneyshow.com and click on the life insurance for a second opinion. Well, welcome back to Right on the Money and to our Conservative Investors and Savers edition. Hello, everyone. I'm Steve Savant, syndicated financial columnist and money color commentator. In this segment, we're talking about fixed annuity rider myths, and I mean, there are a ton of them out there with our good friend, financial advisor Eric Judy. I mean, the list of, what do they call them? Lies, damn lies, whatever. You know, I mean, we got a lot of, there's tons of myths out here about this. Let's go and talk about the big one that you are confronting all the time, and there's misconceptions because a lot of this is coming from so-called advisors.
Yeah, the biggest one is, and we kind of alluded to it before, that 7% guarantee that's thrown out there. A lot of advisors don't even understand that that's not real money. That's not cash that's going to go on to. People talk about that being, that's 7% guarantee, and they stop. If you stop after just saying, well, you're going to get 7% guarantee, what would you assume?
Well, first of all, I'd assume my advisor. Yeah.
And that's exactly.
Yes,
people.
I would assume as a consumer, he just told me I'm making 7% on my cash account. That's what I think.
And that's exactly it. And that's what most people think is happening. That's your money. Well, it's your ledger account. It's your formula for future income that they're going to take in the future, use it, multiply it times your payout factor, which is usually based off your age, and that's going to create a lifetime income guarantee. But it's not necessarily money you can get in there, pull out. You want to go buy a new retirement home? It's not dollars for that. You can't use it
Okay, but if you did pull money out of your annuity, could it actually injure or dicker with your income riders, the money they promise you as an income?
And that's exactly it. Yes, it will. I mean, I don't know of a case where it almost, I'm sure there are cases where it doesn't, but in most cases, when you pull out dollars, cash out of your account, because we talk about 10% penalty-free withdrawals. Well, that means you can go out and pull out 10% of your cash account a lot of times from an annuity. But guess what? You're pulling 10% out typically on that guarantee as well. Sometimes it's not just dollar for dollar, it's pro rata. So if you're pulling 10% out, it's a leverage factor for some of those options.
Okay. So let's make sure I understand what you're saying here, guys. It's a little heady. So I have 10%. It says in the contract I can take 10% out. But it's also told me I have a 7% payout rate, which is not the crediting total return interest rate. Okay,
No.
just that.
Right.
Okay, so I'm getting my 7%. That's just the payout rate. I take that 7% and I say, oh, I have a 10% withdrawal. I think I will. If I take money out of that, that 7% payout rate was dependent on all those funds to stay inside. So take them out at your what?
At your peril.
At your peril,
yes.
because if you did this for income, and I always say this, you have to have liquid assets that you can get to, but you're not dickering with things like this.
Right. And an annuity of this style for income should not be dependent upon for being the liquid asset. There are surrender charges. There are other penalties there. If you have to go in there and get them all, this is probably was a bad choice. Yeah.
All right, now let's talk about this myth, because this is a big one, and I just like to grind an axe all day long on this. I told my client, here's the income rider. It's going to give you 6% at this age, 7% if you wait another 10 years. Depends upon your age. The older you get, the bigger it gets.
Right.
Okay. And I told him that there was a cost to this. All right, now let's just say I'm okay with the cost. Let's say, just to do the math in my head, it's a point. It cost me a percentage point to buy this rider to guarantee that payout.
Right.
But is it a point on my cash value, or is it a point on this so-called phantom income, or you call it funny money?
Yeah. Unfortunately, with most carriers, it's a point on the funny money bucket. And what's most disturbing about
I
that,
just want to make sure.
Yeah,
I'm paying up. It's not a point on my actual cash. It's a point on the future phantom money, which is more than my cash, so I'm paying more money.
and that's what, that 7% guaranteed increase is on your fee as well. So your fee is going to go up by whatever that funny money bucket does, or your phantom account. So you've got those guaranteed increases in fees for the insurance company, which you're paying for, hopefully for a reason, for that future income value. But then, of course, most of the time, the other thing that people don't realize, they're taking that out of your cash. So your cash account's being depleted by whatever the cost of that fee is. Now, there's a value to that. Now, hopefully you understand what you're buying and what those dollars are getting. Because for a lot of folks, they don't ever see that until they get their first couple statements, and then all of a sudden, what the heck is, where are they basing this? They don't understand. It hasn't been explained.
I think you need a full disclosure. Make your financial advisor sit down with you and do it like Eric does. He does always full disclosure. He's doing caveats. He's explaining everything. Now, I don't mind paying for something if the value is good, right? So I don't mind paying. I just want to know, what am I paying? Is it on the phantom account, the funny money as you call it, or the real cash account? I want to know that. And I want to know, okay, what do I get because of that? So I might say, well, I got a trade-off here. I got guaranteed payout of 7%. Again, it's not the interest credit, but just the payout rate. So I'm looking at clients that have money in CDs that are getting nothing.
Right.
They may want to look at some of these annuities because it could not only give them a little bit more money, but the actual payout rate. Now, remember, you may not, I'm just being honest.
Right.
Some of this, if you die early, you may not get your principal back, and there's ways to protect against that. But when we're looking at funny money, we're looking at cash accounts, we're looking at phantom accounts, I just want us to understand, what are we getting into, and is it worth the while? So you told me, I think on the first segment, you said the spread was, some of them were as low as 50 basis points, 0.5%, all the way up to 1.5%, which sounds punitive to me.
Yeah.
Now, if I was selling if I was going to buy one that had such a high fee, it better have a great value.
Well, and what you're typically exchanging there is some sort of basically guarantee for the insurance company. It may be a higher roll-up amount, so it's going to get you to a higher payout factor faster. But the thing is, you have to have known ahead of time really when you intend to use it, because you have to figure out what it's going to cost you over that time, and whether or not there's value there in getting back what you're wanting to get out of it. For some people, it's trying to get that highest income, but still maintain that flexibility, and they're willing to pay for that with those kinds of fees. But for a lot of people, they just don't know what they're buying.
Well, I was looking at annuities basically on a timeline, trying to mark, kind of getting a good guesstimation on when my client's going to die. And so I had this underwritten. I actually had the company tell me, where is she actuarially? And so we figured out, hey, she's going to be about 92. So I'm getting a 6% payout rate, but when I actually did the actual rate of return, she was actually making 3.62 if she lives to age 92. Every year she lives past her life expectancy, is going to be a little bit higher return. So I don't mind telling a client, hey, you're getting 3.62, especially when the bank's not even, or 100 basis points not even close on a 5-year. So I have no problem with that, but I want to, the myth is the payout rate isn't the interest rate.
Right.
And Eric, how many mistakes of this has been made? I even see people write about this and it's a mistake.
Yeah, and it's, unfortunately, we get used to the mentality of being savers. Mm-hmm. So we're used to what the returns of the mutual fund or what the bank's paying, right? And everything there is stated in a yield or a rate of return. We get to the stage where we start taking our money out. Mm-hmm. And the insurance companies have been very good about telling us how much we're getting paid out of what we put in there. Mm-hmm. We're going to be able to pull back out 6% or 7%. That payout rate is what the percentage of what they're paying you of principal that was in that account. So they're not paying you a return. You're not earning 6% and getting back just the interest. You're actually getting back a portion that's both the return of both principal and interest.
Now, is there any way, any riders or any attachments that I can throw on to protect my principal in case I don't get it when I'm when I'm living?
Well, there are guarantees that you can add. Now, most of those are on the annuitization factor.
Which is different than what we're talking about.
Exactly. Most of the riders, it's a lifetime guarantee, and whatever's going to go back to the heirs is usually what's left in that cash account, which of course is where all the payments that you're getting coming out of that account, anything that would be a fee that you're still.
But if you live quite a long time, your cash account's going to be depleted, but you're still getting the payment. That's the trade-off. Here's the value proposition. Okay, so it doesn't matter how low or it goes to zero, I'm still getting the payout.
Exactly.
All right, so that's what I'm trading for the fee. Right. And I just have to figure out, is the fee worth the actual total payment? And especially if I snap a timeline and say I'm going to live to X, I think based on my family's family history, and my good behavior, hopefully. And no more morbidity events. I don't have an accident because they seem to accelerate, geriatric living. When I'm looking at, I've covered the fees, and I don't want to be misusing annuities as a storage facility for my liquid cash. This is a big mistake that I see people trying to do. I'm using it as a storage facility, but I need liquidity.
And you have surrender fees. So every annuity out there, and to be honest, to get any kind of decent return, you're usually looking at things that are going to be 3, 4, 5 years, more likely 10 or 12. The surrender period is much too long. There's much too much of a fee or a surrender charge that's going to inhibit your ability to take that and have liquidity to this back in the bucket. You need to have those dollars somewhere.
Remember, if you're listening to our show on radio, iTunes, or a podcast, you can view the video version online at rightonthemoneyshow.com and request information from this segment. In our fifth segment, we're going to talk about the number one fear in retirement, which is running out of money with Eric Judy. We'll be right back. Shakespeare once said, "This above all, to thine own self be true." Hello, everyone. I'm Steve Savant, syndicated financial columnist and talk show host. It's difficult to make good decisions in life without knowing who you really are. And nowhere in life is this more important than making sound financial decisions. Creating a financial profile addressing your psychological disposition towards money is important, and that's a critical component in the decision-making process on saving, investing, and using insurance to protect against risk. Establishing your own risk tolerance is the first step in providing and building a financial profile so that you can measure your suitability for a financial product or a strategy. There may be many risk tolerance tests available to help you construct your own financial profile. One test that I use could be a good place for you to start, and I'll email it to you free and without obligation. The test will take about 10 minutes, and you'll be able to calculate the results in the comfort and privacy of your own home. So just go to www.rightonthemoneyshow.com and click on the free risk tolerance test. Once you calculate the results, you'll have an understanding of your attitude towards money. Well, welcome back to Right on the Money and our Conservative Investors and Savers Edition. Hello, everyone. I'm Steve Savant, syndicated financial columnist and money color commentator. And in this fifth segment, our final segment. We're talking about the number one fear in retirement, and that is totally running out of money. And Eric, I have to say, this is not an unwarranted fear.
No.
Not with human longevity. I mean, we're looking at numbers. The average, and the 212 mortality tables are coming out here this year. We're going to be looking at these numbers. I look at the average American, of the last resource we did, the average male, 86.6. That's the average. And the average female, 88.8. Now, that means that half of America is going to live longer than that.
Right.
Now, I just want to think about that. So it is a fear. When we were thinking about traditional timelines for retirement, I'm retiring at 65. I'm going to probably die around 80. 15 years, I'll call it a day.
And what's interesting, if you think about people that have taken care of themselves, and there's a difference here socioeconomically, so people that go to the doctor know what's going on in the world, take care of themselves, they take the medicines they need to, they do the exercising, they basically are balancing their body the right way. They, on average, are living, 7 years longer. And so if you think about that in conjunction with what you just said, we're in our mid-90s for a lot of the folks that are, basically have saved a considerable amount of money for retirement. But their biggest fear is, have they saved enough? So you're looking at a combination of Social Security, 401ks. Unfortunately, for a lot of people, pensions are a bygone thing. And so what are they to do to make sure that they don't have those issues of getting to their mid-90s, the time when they're not necessarily mentally as acute as they would like to be for some people, and being able to then manage those portfolios and manage those dollars to make sure that the chance they live to their hundreds, they still have dollars left.
Well, this is a great fear. I mean, I used to watch Willard Scott say happy birthday to a handful of Americans turning 100 in his centenarian show. It was great. And we have about 53 to 54,000 people in America turning age 100 or beyond. I mean, there are super centenarians right now in their teens, 115 or whatever. There's a handful. But I think we're going to be looking at this, and I saw that Professor Aubrey de Grey out of Europe, he's a gerontologist. He says the person that's going to live 150 years has already been born.
Wow.
So I'm thinking, wow, this is not a unwarranted fear. So I don't want to run out of money. I have to have a part of my portfolio. I just have to now. I've come to the point where I have to lay down a guaranteed lifetime income. It's going to be there. I like to put on a COLA adjustment to get a little step up with more money as I get older. And I think this is the way we got to go. And I want to match up. Remember now, even though Social Security didn't pay in 2016, there's only been 2 other years where they didn't pay. And by the way, a little side note, boy, talk about back in the day, how would you like to get a 14%, it was like, I think it was 14.7% inflation bump for Social Security in 1980?
Yeah.
Oh my gosh, the CPI was like, what, 13% or whatever?
Exactly.
It was up there. So let's talk about it. Nobody debates the issue of longevity.
Well, and you have to think about it in retirement. So you've got people in their 60s entering in retirement, and they think they need $50,000, $60,000 to retire comfortably at 60. Now you've got them in their 90s. What does it take to have that same standard of living? So your point about COLAs is very well spoken. You're going to need twice, 3 times the dollars just to have that same standard of living. So we know from a standpoint of do we need to take some of those dollars and put them out there, and as we talked about QLACs, what better way of leveraging some of those dollars and setting them out there so these people that do have that longevity don't have to run that risk of running out of money.
Yeah, and Eric's talking about the qualified longevity annuity contract, QLAC. It'll give you the ability to extend not all, but some of your RMDs. You push this out into the future, and you may need it in the future. I'm also recommending, really, and I say this to my baby boomer brethren, I have to say it, you really should think about a hybrid retirement or working at least to age 70 to max your Social Security out and let your qualified plan have one more cycle in the market before you start taking required minimum distributions. I think we just have to do that to combat. Remember, longevity is a major risk multiplier. The longer I live, like I have this, a lot of my friends, my parents' friends were all dying in 80s, and they said, wow, we didn't have to go to the nursing home. But the longer we live, now we have the exposure of assisted living, at least at home. So that's a multiplier. Longevity is a multiplier. It multiplies my I might need long-term care. 70% of all seniors did some form of that. So when I'm looking at this, I have to make my funds, and my manager, you manage funds. How do I think about that? How am I going to manage funds? I'm not working anymore, and the only income I got is Social Security.
Well, I'm a big fan of Dr. Wade Pfau's study, where he looked at taking basically the bond portion of your portfolio and said, what if we take those dollars and put them to some sort of guaranteed lifetime income product rather than bonds? And we all think, bonds, conservative investments, they're going to pay a fixed dividend. Well, what he found was that if you put those into income products, some sort of guaranteed income, your chance of not running out of money, based off his calculation, was significantly enhanced. And so, as people are living longer and having these issues, not issues, it's benefits, I guess, but as they live longer, how are they going to have those guarantees? And that's taking some of those conservative investments and moving into a guaranteed income source, has a lot of benefits.
Okay, so there's a lot out there to shop. I'm coming to you as a consumer saying, I need to have money from 70, and I'm thinking that I'm going down around 92, but I think my diet-conscious, exercising wife of 40 years is going to be sitting there real close to 100. I think she's going to go.
Right.
I think she's going to be out there. So I need to accommodate that. Can I get guaranteed income on both our lives? Because I think we're both going to be living longer.
Yes, you can. And you can do joint lifetime income. And obviously, probably the first thing you have to ask there is, have you optimized your Social Security survivor benefit? Mm-hmm. And that's where we talked about living to 70. Well, it's really important, even if you decide to take one of the spouse's incomes earlier to help balance the budget and meet your goals at that stage, take that higher earning spouse, you can defer that to 70. That's a huge, huge impact, because when you don't think about it, but eventually one of those spouses is going to die, and one of those Social Security benefits is going to go away. You want to have that highest possible Social Security benefit, because that's what the survivor is going to have the option. They're going to take that benefit. They get the highest benefit. And, of course, then you're still continuing to get that cost of living option off of that right now. So
I think that's a huge point you just brought up, of the survivor benefit. What that survivor, most of them are women.
Right.
You're actually blessing your wife by delaying your Social Security to 70, because that's the number that they're going to mark on her income.
Right, yeah. We just lost the file and suspend benefit, which was a nice little tweak on that. But having that higher earning spouse defer that till 70, major impact, because of what it does in the 90s, those people that are going to live to be 100.
I think there's going to be major adjustments in Social Security. Congress is going to have to come to the table and do something. And I don't think they're going to touch too much more for the boomers, but I think everybody below 50 needs to start looking at accommodations. I think they're going to push out the retirement ages. Instead of 4 retirement ages, 66, 67, it may actually be 70. I wouldn't be surprised if they moved RMDs all the way out to 75.
Right.
I think the timelines are going to be pushing forward. I think living to 100 for the millennials may be status quo.
Yeah, I think you're right. I do. And one of the things you think about is you're starting to enter in how you're spending down your dollars. The other thing that moving some of those dollars to an income product is you take away the risk of market loss on those dollars. You protect that income side of the portfolio. And for folks that are just entering into retirement, that sequence of returns is such a major impact, especially in the first 5 years before retirement and the first 5 years, 5 to 10 years after retirement. You think about living 40 years potentially in retirement. If you had negative years and the compounding effect that those negative years could have right after you retire, if you had a down market and you're being forced to use a withdrawal mechanism out of a portfolio, can significantly hamper your ability to make it all the way to the
A lot of advisors call that the red zone. 5 years before I retire, 5 years after. Almost all the mistakes in retirement are made either side of your retirement date, either just before, 5 years before, or 5 years after. You need to be talking to an advisor. This is not a do-it-yourself process. Retirement isn't. Learning all the code, the taxes, Social Security. I mean, we talked about 4 or 5 things today that I'm hoping people are taking copious notes on, because this is really for their retirement and their lifestyle. I think that when you think about America right now, we're at the place where we're going to be living longer, where our culture of longevity and geriatric lifestyle is going to take over. Think about this. Some of the hotels that we're building today, right, are already prepping to build so that they can convert them to nursing homes and assisted living.
Incredible. Just think about the number of people that are turning 65 every day now, something in the neighborhood of 5,000, 10,000 a day. I can't even remember the number, unfortunately. But the boomers are coming. and we have to be ready.
Well, that's our show for this week. I want to thank Eric Judy for being my very special guest. But before I go, remember what good Reverend John Wesley would say. Make all you can, give all you can, save all you can. I'm Steve Savant. We'll see you next week right here, right on the money.
For more information on this week's money topics, just go to our website at www.rightonthemoneyshow.com and follow Steve's daily postings on Facebook, Twitter, and LinkedIn. When it comes to retirement, money management, small business, insurance coverage, college funding, or budgeting, we have the interviews you can use.